We're ready to start. Just Most of you should know who I am, but this is Henry Dennard, and I want to thank you for joining us on the webinar today. I have invited one of my investment product partners, to make this presentation to hopefully provide some help for you in making your decisions about what to do with the investments that you've been entrusted with. And certainly in this time of what's going on in the world and what's going on in the markets, that I felt like it would be good to invite someone who is involved in this every day to help us get a perspective with regards to investing, especially at this time. So I've invited Sean Morgan with Eventide, and Sean has been with Eventide since 2018. And he has a lot of experience in the industry. And I'm looking forward, Sean, to what you have to share with us. And so at this point, I'm going to just turn it over to Sean, and you can take it away.
Well, hello, and thank you for listening to this presentation called The Timeless Truths for Investing. My name is Sean Morgan. I'm the Manager of Investment Marketing at Eventide. I've worked for a number of different asset managers, and I chose to work for Eventide because I believe in their mission. So I actually sought out Eventide and have been very excited about their mission. And I'm going to share a little bit of that mission through the context of this presentation. Now, before I begin, I do want to note that since the topic of this presentation is investing, please do not take this to be an investment recommendation for your particular situation. You should always consult a financial professional that knows and understands your entire financial picture to advise you. Now, I want to start by sharing with you some headlines from a very prominent investment publication over the course of 2020. We'll start in January, where the headline reads, "The Method Behind the Melt-Up, Why the Dow Won't Stop at 30,000. This, of course, was a very bullish, a positive headline for markets, making the case that this upward momentum that we've been seeing should continue on. And this was January of 2020. I want you to remember that, January. Now, over the course of a very short time, COVID came on the radar, and we essentially shut down in March. So here's the headline from March 23rd from the same newspaper. "What Washington needs to do right now to spare America a second Great Depression." So this was a radically different outlook than just 2 months earlier. Now let's move on to April, just 1 month later. If you remember, the stock market had rebounded from its initial drop, but there was still a lot of skepticism. So on April 27th, the headline reads, "In this stock market, anything could cause the next panic." So now let's fast forward to the end of the year. Now remember our first headline from January that was very optimistic, saying that we really might keep going up. Well, after all of the turmoil and uncertainty that marked 2020, we conclude the year with this headline from December 21st, 2020. "The S&P could gain another 10% next year." So if you would have closed your eyes starting in January and opened them back up in December, you would have read a positive headline in January and then a positive headline in December, and you might not have known anything that had gone on in between. Now, I know that last year was extraordinary, but if you are one that follows the financial news at all, you know that this up and down swing is not necessarily completely irregular. We see this a lot of times. Now, all these headlines understandably cause confusion. What should I do with my portfolio? Is now a good time to invest? Should I pull all of my money out? Was the plan that I made a few years ago still relevant? So I want to answer this question here on your screen and hopefully provide you some perspective. How should we think about investing in the market? And in order to gain a better perspective, I want to take a step back from the headlines and consider some principles that we'll call timeless truths for investing. So for the sake of making this presentation memorable, I've given these principles some catchy titles, but they each teach us something important about investing in the market. So first, keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe. And finally, invest in businesses, not the markets. So we'll start here at the first timeless truth. Keep your eye on the owner, not the dog. What in the world? What does this mean? Well, this actually comes from a a quote from a very well-known investor, Ralph Wenger. Bill Bernstein shares this conversation that he had with Ralph in one of his books. So this is what he says about this conversation he had. He said, he likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch may lurch. But in the long run, you know that he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner. So hopefully you're getting the analogy here. If you're paying attention to the owner, you see him walking directly northeast. Now, if you're keeping your eye on the dog, you would just be seeing him dart up and down, side to side, and not knowing which way he's going. However, you know that eventually the people that have their eye on the owner is heading at a steady pace to the northeast. Now, if you're not making this connection with investing, I'll show you this chart. This chart shows the returns of the stock market all the way back to its inception in 1871. The blue line there that you can see on your screen represents the stock market performance with all of its ups and downs. So in the metaphor, this is the dog that's darting side to side in every confusing and erratic pattern. The yellow line represents the best fit line for the data. And as you can see, it's a pretty good fit. It's a straight line. There's no curvature to it. In our metaphor, this is the owner, the person walking the dog directly north and to the east, translating in this chart as up and to the right at a steady pace. And in this case, it's averaged out over time. It has been a steady pace of 6.7% for 150 years. So when you take a step back from the day-to-day headlines of the stock market, heading up or down, what do you see? The stock market has been a remarkably predictable investment vehicle to invest in U.S. businesses. Our task here as investors is to not be so consumed with what the dog is doing, which can be confusing and misleading, but rather keep in mind that over the long haul, U.S. businesses have been a great long-term strategy for investors to grow their wealth over time. So let's be investors that keep our eye on the owner and not the dog. So let's move on to the next principle. Restrain yourself. Now, it sounds like I'm going to get personal with you here, and indeed I am. I'm going to get personal. There's a little bit of self-reflection we need to do when it comes to investing, and I'm going to get personal with you by showing you this article first. This is going back in time a little bit. You can see that this was published in the Wall Street Journal December 31st of 2009. Every decade, the Wall Street Journal crowns a king of mutual funds for different investing categories according to a fund's performance for that past decade. So what you're seeing here at the end of the first decade in the 2000s is this coronation ceremony for the king of mutual funds. And you can see here the winner of the diversified stock mutual fund category had an annualized 18% return over the past decade, beating the next closest fund by 3%. That fund, as you can see, was called the CGM Focused Fund. And what I want you to take away is this. If an investor had invested in this fund right at the beginning of the decade, and they just stayed in it for the entire time, they never tried to pull their money out and never tried to time it to get right back in at the right time, they would have received an average, right there on your screen, 18% return every year for 10 years. So I have a question for you. What type of return do you think the average investor who invested in this fund over that decade received? Now, you're probably assuming that at least some investors didn't stay the course the entire decade, and you're right. Some probably got fearful when the fund was down, and then they tried to time it to get back in at the right time. So what do you think the average investor received? Well, the article tells us. We can see here that the average investor actually lost money. Read this here. It says, too bad investors weren't around to enjoy much of those gains. The typical CGM focused fund investor lost 11% annually in the 10 years ending November 30th, according to investment research firm Morningstar. So the average investor actually lost money, and it's because of their own behavior. The article tells us right here. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it has had a strong run and then they sell it at its bottom. So this is what happens. Investors are shopping for a fund. They say, oh, look at this fund. It has had really good performance here recently. I'll invest. And then a few months later, if the fund is not performing as well, they get nervous and they think they might have picked a dud. So they pull their money out. And then the fund starts performing well again. And they say, oh, well, I want to be a part of that. So they get back in and they're buying as the fund is getting higher. So in the end, they are actually doing the opposite of what you're doing as far as buy low, sell high. They're actually buying high and selling low, which ends up devastating their returns. And the average investor sabotages himself, and it's very common. This is a book written by Daniel Kahneman, who's a Nobel Prize winner. This entire book that he wrote, Thinking Fast and Slow, it's a very popular book, and if you haven't read it, it's very insightful into human psychology. But the premise of the book is summed up right here in its introduction. The premise of this book is that it is easier to recognize other people's mistakes than your own. This is classic psychology here. It's very easy to look at other people and say, oh man, those CGM focused fund investors, I can't believe they did that, but not me. It's not unique to just the CGM focused fund investors. It is actually consistent across all investors. So let me show you this chart here. What we're looking at is the performance history over 20 years from 1999 to 2019. And these are different categories of investments over time and their returns. So on the far left here, these are REITs, they're real estate investment trusts, which are funds that invest in real estate. You can see that they averaged, right there on your screen, 11.6% per year. High yield bonds, 7.9%. There in the green, you have the S&P 500 bringing in pretty close to that average that I showed you earlier. This is showing 6.1% over this period of time. The light blue is a mix of stocks and bonds averaging 5.6%. Bonds by themselves, 5%. Now, what I want you to see here in each category, I want you to see this orange box here. This is what the average investor received. Look at that number there, 2.5% at the very bottom of this thing. So what we learn here, if the average investor would have just chosen any one of these other categories and just stuck with it, they would have outperformed what they ended up, how they ended up performing. So they are actually sabotaging their returns just by trying to time getting in and getting out. Whereas if they would have just chosen an asset class and stuck with it, they would have performed far better. So this is a quote that I love here. It's from Morgan Housel, who says, finance would be better if it was taught by the psychology and the history departments than at universities. Couldn't agree more with that. And here's a quote from Warren Buffett's partner, Charlie Munger. The big money is not in the buying and selling, but in the waiting. So here's the takeaway. When you invest, you need to turn off that switch in your brain that causes you to emotionally respond to the market movements. And you need to pick a path and stick to it. That is the key to success over long term. So let's move on. Number 3, employ a system that forces you to buy low. So we just talked about how detrimental it is when we buy things when they're expensive and then we sell things when they're cheap. So it would be helpful if we forced ourselves to do the opposite, to buy low and to sell high. And there is indeed a systematic way to do this, and I'm going to introduce it to you by walking you through an experiment. So let's suppose you are dropped into history anywhere between 1920 and 1979, and you must invest in the U.S. stock market for the next 40 years. You're earning an income from your job, and you have 2 strategies to choose from on how to invest this leftover money that you're earning. Option 1, you can consistently invest $100 a month, every month, no matter what, over 40 years. So no matter what the market is doing, you just take your $100 from your income each month and you add it to your investments. Now, option 2 is that you save that $100 per month and then you only add that to your investments when there are dips in the market, meaning most months you're actually not adding to your investment account. That $100 a month is just sitting in cash, and you might build up $800 to $1,500, and then when the market dips, right before it goes back up again, right at the very bottom, you invest all the cash that you had been building up. Now, no one has proven themselves to have perfect knowledge of when the bottom of these dips occur in real time. They're always realized in hindsight. But for the sake of this experiment, I'm going to grant you this superpower that you actually have perfect knowledge in real time to sense when the market truly bottoms before going back up again. So the question is, which strategy would you choose? Option 1, where you're investing $100 every month, or Option 2, whenever you save that money and only invest it whenever the market dips. Which one do you choose? Well, we actually ran this experiment, and well, we didn't run this experiment, someone else did, so trust someone else's data here. But I'm going to teach you how to read this chart here because it's a little bit confusing. So every point in time that blue line there on your screen is above the dotted line, that is when you would have been better off waiting and buying the dips. So obviously, if you started these strategies in the 20s, the buying the dip strategy would have outperformed. And it makes sense because you would have saved up all of your money and missed out on some of the opportunities during the roaring 20s. But you would have invested all of it at the very bottom of the Great Depression. So you would have missed that entire downturn, invested at the very bottom here. But look here. If you would have started these two strategies at any point after 1940, you would have always been better off consistently investing $100 every month. So 70% of the time, you would have actually been better off choosing option 1, where you're just investing the same amount of money no matter what every month. So let me sum this up for you. Monthly investment outperforms buying the dips 70% of the time. So odds are in the favor of option 1. Now, also, I want you to remember that I granted you a superpower that no one has, the flawless real-time awareness of when the dips are occurring. So option 2 is actually not a realistic option because no one actually has this superpower. So if we reduced this superpower down to everyday human ability, and we said we will grant you the ability to invest within 2 months of the market dip. So you're not necessarily spot on as far as when that true dip occurs, but you're within 2 months of being accurate. If we just change that just slightly, then the monthly investment strategy actually outperforms 97% of the time. So how can this be? The idea is to buy low, right? So if you waited and bought at the bottom, at the very bottom every time, you should outperform, right? So there seems to be something magic about option 1, where you're investing the same amount of money every month, no matter what. Well, it kind of seems like magic, but there's actually a name to it. It's called dollar cost averaging. Now, dollar cost averaging is the practice of investing a fixed amount of money at regular intervals over time. For example, the example that we just gave is $100 a month. Now, by investing a fixed amount of money, this strategy buys more shares of an investment when prices are low and less shares when prices are high. And I'll show you how it does this. So this is the S&P 500 from the year 2000 to 2010. This is a very tough time period to invest. We had the dot-com bubble and the financial crisis kind of all wrapped into this same decade. A lot of people call this the lost decade of investing because in 2010, the market was actually down 24.1% compared to where it was in 2000. So it's pretty depressing. So how would dollar cost averaging strategy done during this decade? Simply by investing in the S&P 500. So this is just the returns here of the S&P 500. Now I'm going to shrink this chart and move it to the top of your screen. So that is that same chart on the top of your screen. Now at the bottom here, what you're seeing is how many shares you would have been buying along the way if you were buying $500 a month worth of shares every month, no matter what. So you can see it works exactly as I said. When the market is peaking, your $500 does not buy as many shares because shares are more expensive. Now, when the market is down, your $500 is able to buy more shares. So you are actually forcing yourself to buy more shares whenever the market is low and buy less shares when the market is high. So notice that this is a buy the dip strategy in disguise. So every time the market dips, like take a look here in 2009, you're buying so many more shares than you were when it's high. But you weren't even trying. You weren't even thinking about it at the time. It's just built into the strategy. Now, very importantly here, if you were to employ this strategy, your return would not have been negative 24.1%. It actually would have been a positive 5.9% over that period. So it's great. I like to pull in some unexpected characters into the presentation. This is Napoleon. He says this in regards to military genius, but I think it also applies to investing genius. The man who can do the average thing when all those around him are going crazy. No doubt, dollar cost averaging may be pretty boring, but as we saw, it can be a genius strategy. So let's move on to number 4. Remember the most powerful force in the universe. Well, what is this force? Let's ask Albert Einstein. The most powerful force in the universe is compound interest. Now, Einstein is known for being a genius, but not necessarily for investing. So why is he giving such praise to a thing like compound interest? Well, let's talk about it. I'm going to introduce compound interest by using a very classic investing example that you might have already heard of, but I'll walk you through it. This is called a very expensive cup of coffee. So let's say that you purchase a cup of coffee every day for $3 a day. Then one day you decide to no longer purchase this daily coffee, and instead you want to invest that $3 a day. Let me ask you this. After 40 years, how much would you have? So let's use that historical growth rate that I showed you of 6.7% per year. That's, remember, what the S&P 500 has averaged over the last 150 years. How many of you think that you would have over $50,000? That's a lot of money by just not buying coffee for 40 years. How about $100,000? Now, the answer is, are you ready? $215,000 because of compound interest. So let me explain this to you. Benjamin Franklin says compound interest is money makes money, and money that makes money makes money. Well, that sounds confusing, but it is actually an accurate description. It's very profound. Let's look at this concretely with this coffee example. So $3 on coffee saved is $1,095 per year. Now, if you were to invest that amount of money at the end of that year, it would grow 6.7%. You would end up having $1,168.37 after year 1. And after year 2, you add another $1,095 that you saved by not buying coffee, which is then added to that previous $1,168. And then that money put together, which is more money, is earning 6.7%, which is actually a higher dollar amount. 6.7% is higher on the higher dollar amount, the $2,162 that you get when you add those two numbers together. That grows. And then you do that again, over and over and over again, and it compounds the power. So let me show you this in a chart, because the results are astonishing. The yellow line is what $3 a day looks like if you were to just save it, just put it into a savings account and it doesn't grow. So over 40 years, you would have over $43,000. So $43,800 is what $3 a day saved looks like over 40 years. So 40 years from now, if you want to be sure that you have $43,800, congratulations, you can put it in the savings account. Now, if you were to invest it and it were to grow and compound interest over that same time, look at how much money you would have had. That's that $215,000. Now, I want to use a little bit more realistic of an example. This is what a lot of people end up doing just as a regular investment strategy. For someone maxing out their IRA at $6,000 a year, the same concept applies. So if you were to save that amount of money over 40 years, you would have $240,000. However, if you were to invest it, you would have over $1 million over that same period of time. And so what I want you to notice here is that this compounding interest, it really takes some time to start catching steam. You see this kind of hockey stick type growth that really starts occurring around year 20. So as your money builds and you're making more money off of more money, that's whenever you can see the compounding power really start to take place. This is what we call the everyday millionaire. The people that do the same thing slowly over time can start to see these drastic results whenever you see the power of a thing like compound interest. So this is the Rolling Stones here. Time is on my side. Yes, it is. Use time to your advantage. Start investing and see the powers of compound interest over time. Here's a quote from Buffett. The stock market is a device to transfer money from the impatient to the patient. So fifth point, we're moving on quickly here. Invest in businesses, not the market. And this is one of my favorite points. It's one of the most important points, and it's a way to keep you calibrated on what investing truly is. So many people have lost sight of the true purpose of investing. Investing has long been divorced from its original and most basic purpose, which is supplying capital to businesses. So how do most people think of it? Many people are simply trying to profit off of the market itself, rather than from any productive or intrinsic value of the underlying companies. So what happens as a result, when this company or ownership perspective is lost, our relationship becomes all about performance, which means we end up chasing the ups and downs and the rises and falls of the market. So we feel great when it's up, and we feel bad when it's down. And you're not the only one that feels this way. This is a quote from a professor at DePaul. Retirement accounts tend to just go into mutual funds where not only do I not have any idea of how the companies that I have stock in are being operated, I also don't even know what companies I have stock in. And they're run by an elite of managers whose one preoccupation is with increasing the bottom line. So I imagine that as an investor, at one point you say, what am I actually investing in? Where's my money going? What am I actually profiting from? These questions a lot of times are difficult to answer, and we in the financial industry have not done a very good job of making this any simpler. So this is a quote from Cliff Asness, who is the managing and founding principal of a very large investment company. I heard him speak at an investment conference a few years ago, and he said this: I pride myself on not knowing what's in our portfolios. So here's a guy whose job it is to invest in companies on the behalf of his clients, and he's saying it's a point of pride for him to not know which companies he's invested in. Why? Well, he's a numbers guy. If you got the right combination of metrics and financial performance, then he doesn't even care to look at what the company is doing or who the company is. He just invests in it if it meets these certain requirements. Now, on the one hand, this takes an incredible amount of discipline to implement this strategy. On the other hand, think about how distant it is from the true purpose of investing, which is supplying capital to companies. So I want to remind you that whenever you invest, even if you're investing in mutual fund or ETF, you're actually investing in companies, which is why you should also consider your values and the values of the company. So since you are indeed an investor, you are an owner of the company. So you supply the capital to the company. As a result, you get the rights to profits and growth. That's why we invest in the first place. And with this comes an ethical responsibility. So you ask, is this company actually doing good things for society? Where are my profits coming from? And since this investing is company ownership, the first and most basic questions of investing should always be ownership questions, like how is the company being managed? How do they treat their stakeholders, their customers, their employees, their suppliers, their host communities, the environment, and society more broadly? Now, we should also ask questions like this. Would we want to work under the leadership team? How likely are we to recommend their product or service to a friend or colleague? Would we want our son or daughter to work at this company? On a scale of 1 to 10, how much value does this product bring to humankind? If we walked into a supply center, would we be proud of the quality and the working conditions? What would be our reaction if this company opened an office in our neighborhood? Or what about a supply center, a plant, or a factory? Does this company's environmental policy and actions leave a better planet for our grandchildren? These are just some of the questions that you can ask whenever you start to take this ownership type perspective. Whenever I'm an owner of a company, as an investor, what types of companies do I want to invest in? What types of companies do I want to own? And I'm going to wrap up here with a quote from our Chief Investment Officer at Eventide, Dr. Finney Curavilla. He says this: Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts the management, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines attractive points to invest further. So when you understand the merits of the companies in which you invest and better appreciate what you own, you can transcend a mere chart-based financial relationship in investing. You can then have greater confidence and less stress because you are not buying mere paper or a derivative, but quality businesses that you know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress. So one last time, a recap of our 5 timeless truths for investing. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe. And remember to invest in businesses, not the markets. And that's at Eventide what we call investing that makes the world rejoice. Thank you for listening to this presentation.
Thank you, Sean. That was a great presentation. I hope everyone enjoyed it and maybe found something in there helpful. Appreciate your time doing that. And I want to let everyone know that that this has been recorded. We will reach out. I'll reach out to you with regards to a link to that recording at some time in the near future. And I'll be following up with each of you with an email just to check in and see what you thought of the presentation. And as you see my contact information there on the screen, feel free to reach out to me with any questions you might have about anything that Sean presented today, or any other questions you might have about investing or financial planning, or any questions about finances in your life. So again, thank you, Sean, for the great presentation, and for Eventide for providing this for us. Hope everyone has a blessed day and a blessed rest of your week.